And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is David Peters, who's founder and the owner of David Peters Financial Group. David, welcome to the show.
Thanks so much for having me, Adam. I'm looking forward to a great conversation.
It's likewise. So David, before we jump in, I know your background is more of the CPA side, the accounting and the financial or planning side of the business. And you also do some asset management work. I'm really interested to hear all about your story. So my first question is, can you please tell us how you got to where you are today?
Yeah, well, I don't think that anyone necessarily takes a straight line in their career and in their working life, and I was certainly no exception to that. I started off actually working as a staff accountant for a hedge fund in Richmond, Virginia, and that was kind of my first exposure to asset management. And so we did a little bit of everything. We did some trading mainly in commodities, but we also did some things with REITs and some other real estate deals as well. And I did that for about 3 years. And then the financial crisis in 2009 hit, and I all of a sudden found myself without a job. And so I ended up working for a startup insurance company in Richmond, Virginia. I didn't have an insurance background before that, so I basically was just looking for something. And I ended up at Elephant Auto Insurance, where I got plugged in as a technical accountant and started working my way into kind of more of the regulatory and compliance side of the insurance industry. And I really learned a lot in a very short period of time. And I did that for a few years. And then I was asked to help start a new company, an insurance company called compare.com, which is a price comparison website, sort of like Kayak for auto insurance, if you want to think about it that way. And I was the CFO of that company, and that was a startup endeavor by Admiral Group in the United Kingdom. Admiral Group is the third largest auto insurer in the UK. And so we were kind of their United States venture. And so I did that for a while, and I swore off of startups. I said, I'm never going to do another startup ever again. And then I started working for a friend of mine in Charlotte on the financial planning side, and really got into kind of working with clients, and really kind of just really got excited about just helping out families, and just kind of using my financial skills and knowledge to help other people. That was, I think probably the biggest draw there. And I did that for a few years. And then after saying I would never do my own startup, I decided to go out on my own. And so I went out on my own, and now I do a little bit of everything. I have the opportunity to do tax preparation and tax consulting. But I do still broker insurance policies for folks: life insurance, small business insurance, health insurance. And I also do a lot of work with financial planning and asset management as well, a lot of retirement planning. I also teach and speak all over the country. So I do a lot of stuff on the education side as well, educating clients, but also educating other practitioners, financial advisors, insurance agents, and tax preparers as well.
I love it. So you have a unique background here of coming to it from the CPA side, the planning side, also a little bit asset management. Can you speak to us a little about the planning side of the business and the overlap with the asset management side, your investment strategy, and how you handle risk and all that fun stuff, please?
Sure. Yeah. So, I mean, I've always come at this as that asset management grows out of financial planning. So it's not really the other way around. And I know that, some clients, they come into my office and they know exactly what they want in the portfolio. But I typically find, at least for my client base, that that's a rarity. I mean, a lot of times people just know that they have gotten to a point in their lives where they just want some additional help, and they want someone to take control of their financial lives. And so we typically start off with making a financial plans. And when I say a financial plan, I don't just mean in the area of where should we put our investments. I mean everything. I mean taking a look at insurance, taking a look at life insurance, taking a look at tax situations of the client, taking a look at old tax returns, looking at the portfolio, looking at retirement assets, really doing kind of front to back planning. Then what we do is, and typically a financial plan is if you do it right, I think it's going to take place over a series of meetings. It's not a one and done by any stretch. And even once you give the deliverable to the client where they have kind of this, it used to be a big binder. I guess these days we don't really use binders anymore. It's a big PDF at this point, but, they give, once we give the deliverable to the client, we're still tinkering, we're still working, we're still trying to, figure out what's best for the client. And so, and that's where kind of the asset management side happens. We suggest, putting money into a Roth IRA, or we say, hey, why don't we consolidate some of these old 401ks so that we can actually have them kind of all sort of guided in the right direction. And so that is, kind of where that happens. You asked about risk as well. I mean, I think it really depends, especially right now, I think, especially in a bear market where it's been a tough year. I mean, I think for a lot of us, when it comes to risk, it really depends on kind of where people are at in their lives. I think, for some of my clients that are kind of young working professionals, entrepreneurs, they're not really caring a whole lot about, the fact that it's 2022 and yeah, we're having a rough year, but, if they got 30 years until retirement, honestly, 2022 is kind of a blip on the map. And so we've talked to those clients about, the fact that, we don't really necessarily think that things are going to turn around right away. And that's probably going to be next year before we start seeing any turn in the markets. And so, so we, at least any sustained turn, I guess we've had a couple of good days here and there, but, and I think just getting them to understand that if they're on board with that, then, and they're okay with it, we have said, okay, let's go for kind of long-term growth. Do maybe some momentum trading along the way, but for the most part, look for long-term growth. For my retirees, it's been all about controlling volatility, especially here more recently, just trying to make sure that they have the cash that they need to actually survive and get by. And we talk about, things like withdrawal rates from the portfolio, how much can I take without necessarily compromising how I want to live in retirement and things like that. And for some of my clients, that has meant, maybe we take a little bit less out of the portfolio than we typically have done in the past. For other people, we say, hey, study's the course, because, you could be taking more, but if you're happy, then, pull out what you need, and we'll just try to make sure that we're reallocating on a regular basis. And that's really about it. So risk, I think, is an interesting one right now for sure.
Yeah, I love that. So you're more of the planning side is the bread and butter.
Yeah.
But after you plan, then you look at the asset allocation and you adjust accordingly, depending on the risk, modules and all that kind of stuff, depending on the individuals or the family's needs and objectives, so on and so forth. You mentioned earlier, before the interview, that you're a long-term value investor and you look at ETFs and mutual funds. Is that a good overview of a description?
I think that that's very accurate. I mean, a lot of times my clients are looking for diversification. If they're younger, typically they don't have large accounts. And so, probably the quickest way to get good diversification is ETFs and mutual funds. We tend to lean more towards ETFs because ETFs tend to be more tax efficient. And so, we do look at the tax side, which I do think makes us a little bit different from a lot of other financial advisors and a lot of other money managers, is we do focus heavily, because a lot of those clients, we may be doing the tax return as well. And so trying to make sure that, we are setting ourselves up well for the long term. We also tend to try to, especially when folks are younger, we try to get them to at least look at Roth contributions as well, to try to give them some ability in retirement to pull from a Roth account and get that tax-free growth and that tax-free withdrawal.
I love it. So let's go a little deeper, if we can, about the financial planning, because there's a lot of question marks about how to come up with a good financial plan. What are some mistakes you see people make with respect to creating a plan? First question. And the second one, or some of the good things or, the pros of the positives that people make with respect to making a plan.
Yeah, I think that a lot of times when we see folks making a plan for the first time, I think a lot of times they really don't know what to expect and they really don't know what to get out of it. And they focus very heavily, typically on either the investments or the tax return. So I think that those are kind of the spots that I think are kind of the most in your face, I guess, for lack of a better term, for a lot of people. They see their tax return every year. They know what their refund is every year. Their investments, they get statements on a regular basis. And so I tend to see a lot of people when they first come in, they're focusing very heavily on those things and not necessarily looking at kind of the entire financial picture, looking at things like life insurance, looking at things like disability insurance, and those are hard conversations, I think, to have with clients. No one wants to think about their own death. No one wants to think about, what happens if I can't work anymore. No one wants to think about that stuff. And so, but part of my job is to make sure that they are thinking about it. And so that is, typically what I see. Sometimes within the portfolio itself, a lot of times we see people coming in, especially if they've been with the same company for a long time, highly concentrated positions. So, a lot of times in employer stock, that's pretty common. They come in with a heavy amount of employer stock. Also, endowment bias is kind of the academic-y term that we tend to use when somebody wants to hold on to something simply because of, they inherited it maybe from, their mother or father or something like that, where it has some sort of like special meaning to them. And talking to them about that and kind of what that position is doing, that is, probably some mistakes that we see within the portfolio. So I would say just, kind of overly focused on kind of one area of the plan to the neglect of others. And then, also just kind of highly concentrated positions and also just kind of endowment bias within the portfolio. The one thing I will say, you asked about the good side. I mean, the one thing that I love about people who ask for a financial plan is they're usually pretty committed at that point. I mean, because we tell them, straight out, we say, this is not an easy process. This is not a one and done. This is not one phone call. Like, you're committing to multiple meetings, multiple phone calls. It's going to be a very detailed look at your financial life. And so most of the time, if people are like, yeah, I'm in, and they start sending stuff right away, I mean, that means that they're really kind of committed to the plan and they're open to suggestions that you're able to make. And so I think that that's probably the biggest plus, is if you get somebody who is open to that idea, I think that, that they're going to be a client for a long time.
It's almost like working out where your body can do more than, but it's mental, right? The more than your
Yeah.
mind. The mind gives up first. It sounds like a lot like that.
I
Yeah.
think that's an excellent way to put it.
Thank you. Okay, beautiful. Next question. What are some timeless lessons you've learned along the way, whether it's business, investing, family, life, balance, however you want to go, and that you'd like to share with the audience?
Yeah, I think there's probably at least a few that I could talk through. I mean, I think for me, probably the biggest lesson that I've learned on the business side is that it's not a matter of picking the highest net worth clients. It's a matter of picking the right clients. One of the things that I think is kind of a natural thing to do when you first go out on your own in any sort of financial services industry, especially if it's your money that you're investing and basically you're funding the company out of your own pocket. It's a scary situation. And I think all of us, I think to a point, look for just any revenue that we can find. And it's maybe a little bit easier to say now that, I'm a little bit more settled in my career. But I think that the biggest thing I've learned is that, the clients that you have that, are really a good match for you, they're going to naturally gravitate towards you. And anytime that I have ever given up a client, because we just didn't click, their personalities just didn't match, I've actually never looked back at that and said, oh, that was a mistake. I actually have always looked at it as, as that is usually better off for me. It's also better off for the client too. Especially when you're looking for a true financial advisor, you need somebody who you can click with. You need somebody who you can talk to very frankly, very openly, and someone who can put things in the way that you can understand. And so letting them go is not necessarily a bad thing. And typically what I found is that, if I give up, one client that just didn't match, I usually find, two more that do. And so I think that that's something that, if I could go back, that would definitely be something I would tell my old self, is just to be patient and look for the right clients. It's sort of like that old, I guess they used to call it the 80-20 rule, right? So if you kind of reverse that, 20% of your clients probably cause 80% of your problems, and so I'm a big believer in that. I think probably a second thing too is invest in people and infrastructure sooner rather than later. I think that again, a lot of financial advisors, I think a lot of times we're getting paid based off of AUM. And it's typically going to be a percentage of that. And so I think what happens a lot of times is we're so focused on the revenue side that we forget to build something sustainable. And you need good systems and you need good people. You can't expand very far without having those two things. And I think that many financial advisors have figured that out. A lot of times the hard way is that your people and your infrastructure, that's really everything. And that's going to lead to sustained growth. And yeah, it tends to be a little bit of a financial stretch kind of early on to hire somebody, especially if you're first getting started and everything. But the fact is that if you're really going to grow and you're really going to make a go at it, I think that that's an important piece that you got to get into place. Is you got to get people that are just going to resonate with you and that believe in the vision that you were trying to set.
No, that makes great sense. And some timeless mistakes you've seen people make that you'd like to share with the audience, in addition to taking on too many clients or the wrong client, not saying no. What else would you like to share from a mistake standpoint, and how to overcome it?
Yeah, so I think that some of the mistakes that I see with people is that just staying with a business plan that's a little bit too long. That's something that really doesn't work. Staying with something a little bit too long. Staying with something that you thought was a good idea in your head. But I think it's I think in the financial advising books in the area of behavioral finance, they tend to call that loss aversion, right? So kind of a similar idea there. It's like, well, if I continue on with this idea, it'll eventually work out. It'll eventually come my way. And that really kind of ignores if it kind of ignores what common sense is telling you and what kind of the market is telling you, then you need to let that go. And that doesn't mean that you have failed or that you're not going to be successful. But I think sometimes people are kind of so focused, especially with a lot of the entrepreneurs that I talk with, and that are some of my clients. Some of the things I've seen in the past is they're so locked in on an idea that they don't want to admit it if it's not going their way, and they're kind of shutting out opportunities that might be there. And I think it's good to keep your eyes open. It's good to keep an open mind. And one of the things that I would say to any entrepreneur that's out there is that keep swinging. It's not necessarily the first idea that is necessarily going to be the one that's going to stick. And so it's a matter of kind of realizing when to cut it off. I think probably more than anything else. The other thing that I would say too is always have a good sense of where your own burnout level is. I think that that's important as well. A lot of my clients are startup clients. They've helped start businesses, or they're starting up businesses themselves. Sometimes they have investors, sometimes they don't. But starting up a business is hard. It is hard work. It is not a 40-hour a week job. Most of the time, it's a lot of times it's a 100-hour a week job. And some people are just not able to do that with some of the things that they got going on with family and friends, and all the other things that that are just part of living life. And so I think, having a good sense of where that burnout factor is and, kind of when you're about to reach it, I think is a good thing to know as well. I do see a lot of entrepreneurs that just kind of fizzle out, not necessarily because they were necessarily doing bad things or because they weren't making progress, but they were just trying to grow at all costs. And, usually that ends up leading to trouble. And again, and I guess that kind of leads back to kind of my comment about infrastructure and people. I mean, at some point, you got to bring other people on, and you got to help kind of grow it in the right way.
No, makes perfect sense. Great answer. How about the best piece of advice you'd like to share with the audience?
Yeah, that's a tough one. I think that probably the best piece of advice that I ever got was from a mentor and a friend of mine who said that if you the best way to get to know somebody is to ask. And so, what he meant by that, I got to give you more context than that, I think. But what he really meant by that is that a lot of times, especially in corporate America, we tend to have bosses that we don't know. We tend to have people that we don't know anything about them, sort of outside of what they look like and what their title is. And I actually think that that's getting worse right now when a lot of people are not necessarily going to a physical office. I think a lot of times, there's a good bit of the time where we actually don't see the people that are in charge. And so what he used to do that always used to be amazing to me, no matter how many hours he was working, he would always just manage by walking around. I mean, he would walk around, he would talk to people, he would ask them what was going on in their lives, what was going on in their working lives too, what problems were they having, and how could he help. And I think that just that small little, touch point, I think from one day to the next, I think made all the difference in the world. Especially if you are in a situation where you have a growing business, I think it's easy to kind of, try to let other people kind of handle stuff, and maybe become a little bit disconnected the bigger the company gets. That's at the point where it's even more important for people to kind of know who you are. And again, it doesn't take much. It's just a matter of walking around and talking to people and just asking what's going on. And I think that touch point makes a huge difference to a lot of people.
Beautiful. And I guess final question for you today, David, is what's the best piece of advice you'd like to give to yourself from 20 years ago or 10 years ago, or your former self, or anyone in the audience that getting, that's younger?
Yeah.
Older, for that matter.
Or older for that matter. Yeah.
Yeah.
I think that, if I were to go back and I were to talk to me 20 years ago, I would just say, be patient and enjoy the ride a little bit more. I think, I was always pretty hyper focused on trying to grow grow my career, grow in my professional life. And I didn't quite know what all of that meant, but I think that, a lot of times I would get frustrated just because I felt like, I wasn't at the level that I wanted to be. And it made me so that I was impatient, and it made me so that I was probably a little bit more of a bear to work around and to be around than I could have been. And so I think that that's what I would say. Just be patient, and also too, if you have something that you want, don't be afraid to try it. I mean, a lot of times, a lot of people, they walk around and they say, man, I wish that I could do this, that, or the other thing. My goodness. I mean, take a swing. I mean, if you're wrong, you're wrong. But at least take a swing. And I think that it's okay to be wrong. It's okay to change paths. I think if you're going to make it as an entrepreneur, I mean, I think that that's kind of part of the gig. So
I love it.
So that's what I would say.
Love it, love it, love it. Well, David, thank you so much for coming on the show. It was an absolute pleasure, and hopefully we'll have you on again soon.
All right. Thank you so much, Adam. I appreciate it.
Talk to you soon.